Welcome to the HIT podcast, H.I.T, Human Resources, Insurance, and Technology. I'm your host, Toby Kennedy. As we do every week, we're dropping into your feed with what I hope are bite-sized, digestible, well-curated conversations going on in the space. This week's episode is brought to you by Montage Insurance Solutions. And without any further ado, I want to get into a topic that I've been fielding a lot of questions about. And that is some of the alternative funding options out there. So we can do our fully insured plans, no problem. Give a bunch of premium to the carriers, get a bunch of health insurance. Gotcha. There's a lot of talk about self-insuring as well, where you may take on a much reduced amount of premium because really all you're buying is stop loss coverage, you're funding the claims, et cetera, et cetera. We've done a few different episodes on that. One thing we haven't touched on in quite some time is a middle ground there. MERPs, Medical Expense Reimbursement Programs, they're similar to HRAs, although they're slightly more flexible on sort of what you can pay for. And I just want to dive into that a little bit again today because I'm seeing a lot of questions about that. So on the MERP arrangement, you buy a fully insured plan. So you can have your same network. You can have your Kaiser plan even. You can have your Anthem. You can have whatever carrier you have and have that same network. But what you do is a twofold strategy. You save a lot of money in premium because what you buy from that carrier, the underlying health insurance plan, has a much higher deductible. It's a lower actuarial value and therefore is a lower cost plan. So you save a bunch of money in premium and give everybody a high deductible, but that's not the end of it. You don't just give the employees a high deductible where they have to pay for all the costs. You equip them with a card, and when they swipe that card, the card pays the deductible for them. You're using your premium savings to help fund claims and also typically help fund a stop loss that's going to perform if claims get too high. So a lot of the times the way employers like to design a MERP plan is not necessarily claims based, because from a cash flow standpoint, you're going to have employees having claims some months, other months higher claims, lower claims, etc. What's nice is when you sort of level out the estimation of claims and you just bill that flat fixed level amount. Sometimes folks are familiar with a self-insured product called level funding. This is a similar idea where what you do is take a guess at the amount of claims, estimate that over the cost of the year, and smooth that out on a monthly per person basis to where you say, hey, look, this is what I think you're going to have to set aside for claims funding. Obviously, if you run light, you don't have as many claims, you can get that surplus returned at the end. If you run heavy, if you have more claims than anticipated, part of what you're setting aside is claims funding, and a small piece that is actually a premium that goes to a stop loss carrier who will perform if your claims run too high. So what's cool about the MERP is sort of, hey, listen, it's running 6, 7, 8% below a traditional fully insured plan. And it's something you can tack on to your existing network, including tack on to Kaiser, where you say to your employees, hey, look, we're not changing the health insurance on you really. What we're doing is adding a deductible, but we're giving you this card, swipe that card. And of course, if the card doesn't work at claims time, if you pay out of pocket, you need to be reimbursed, we can set up for that as well. So functionally speaking, you're sort of just telling the employees, hey, we're changing up the health insurance a little bit, so your logistics will change. Don't reach for your Chase card or your Amex card, reach for this card and it will fund the claims for you. So interesting thing to sort of talk about, look about. The other kind of atypical on the rise is ICHRAs. We've also talked a little bit about those as well, but that's the individual coverage health reimbursement arrangement, where what employer does is basically say, hey, look, we're not going to offer group health insurance anymore. We're cutting that out. What we're going to do is pay for your guys' individual coverage. And so you send everybody out into the individual market. Now, when you work with a nice vendor, and I'll call Bavy out by name because they do a great job. They're backed by Milliman. So what they'll do is help you build sort of this shopping site where your employees go to. You're not sending them out into the wilderness. You're not sending them out to cover California. They go to this sort of shopping site, and what they see is all of the different health insurance options. And because they're all technically individual, there's no claims that you need to worry about. So if you have a high claim population, this is a decent fit. Also, you don't need to worry about participation. Some folks want Kaiser, some want Anthem, whoever's participating in the individual network, they can buy from those carriers. So it's just another way to kind of break up your health insurance that we're seeing on the rise a little bit that I just wanted to discuss and sort of reiterate. And by the way, we have done deeper dive episodes on this stuff. Speaking of different funding mechanisms, some folks will also get onto an HSA. And the new limits have been announced for 2027. So just want to drop that information as well. Previously, the maximum contribution was $4,000 for an individual and $8,750 for those on family coverage. That's the 2026 numbers. 2027 is going up to $4,500 for an individual or $9,000 for a family. And the catch-up contribution for those over 55 remains at the $1,000 catch-up. So those are some of the new HSA limits for how much you can set aside. There's also limits on deductibles, how minimum deductible amounts, and it's $1,750 up from $1,700 for an individual and $3,500 up from $3,400 for a family. So the 2026 numbers being replaced by the 2027 numbers, which have dropped and are coming out. Just want to give everybody that brief little update. So wanted to dive a little bit into MERPs and then steer you back, if you'd like, and do a deep dive episode that we did. Dive in a little bit on ICHRAs and steer you back to a deep dive episode that we did if you wanted more information. Touch on the breaking news of the HSA limits changing. Yes, and one more thing I wanted to talk about before we actually get out of here is interesting. So we're talking about account-based stuff. We just talked about the HSA limits. On the HRA side, we're seeing GLP-1 HRAs, which is kind of interesting. So several of the HRA vendors have already reached out to us to say, this is going on all over the space, where what employers are doing is carving the GLP-1 coverage out of the health plan because it's expensive, it's unpredictable, and more Americans are becoming eligible for this, especially as eligibility requirements broaden. So it's not just that folks are broadening, it's that eligibility requirements are broadening as well. And so when employers see this kind of unpredictability, some of them are thinking, all right, here's what I'm going to do. I'm going to carve the GLP-1 coverage out of the health plan entirely, and I'm going to set up an HRA for it. And when you do that, the funds are still tax advantage to both you and the employee. So it's not a taxable event for the employee. It's, the HRA function, the tax advantage HRA. But you get to set sort of eligibility rules and requirements, and you can even make them more broad. Maybe it's just the medicine. Maybe it's the medicine and lab work, and nutrition coaching, and the doctor visits, right? So some employers are doing this not only for cost containment, but also recruitment, where you can say, hey, listen, we have a special HRA dedicated to GLP-1s to make sure that you get X amount of dollars or X Y amount of coverage to sort of go towards that. So that's been another kind of unique and interesting thing that we're seeing in the space that we just wanted to touch on today. So wanted to make sure that we touch on those few things. ICHRAs, and we've done the deep dive, so go back and find that episode. MERPs, and we've done the deep dive there, so go back and find that episode. Some of these alternative fundings, and of course HSAs with the new limits coming out, and the GLP-1 HRAs, which is just kind of a newer thing sort of going on in the space. And that's our goal here. It's really just to keep everyone abreast. Sometimes we have great guests, sometimes we have new breaking information, but we appreciate you guys joining us every week. Thank you to our sponsors as well, Rula, Excel Health, TrueU, Montage Insurance Solutions, the guys keeping the lights on. We're so blessed to be here. Thank you guys for joining us. Join us next week. Join us every week. And until next week, make this the best week yet.